Welcome to Talk Tickers. We are diving deep into the financial narrative shaping the future of technology, and today's subject is truly explosive.
It really is.
We're unpacking the Q2 fiscal year 2026 earnings call for Credo Technology Group, that's CRDO, which took place after the close on December 1st.
And this wasn't just another earnings report. I mean, this was an event. What came out on this call, it instantly cemented Credo's status as a necessary infrastructure provider for the whole global AI build-out.
So our mission today is to really distill why these results drove such a violent, positive market reaction.
Exactly. We'll focus on the hypergrowth, the elite margins, and the game plan for the future.
Okay, let's just jump right in with the headline numbers because they were monumental. The market was expecting a beat, but I think what they got was a complete blowout.
Oh, absolutely.
Credo reported Q2 revenue of $268.0 million. And to put that in perspective for you, that's a 20.2% sequential increase.
And a staggering 272.1% jump year over year.
Right. Staggering is the word.
Yeah. The street consensus was, hovering between maybe $235 and $240 million. So they didn't just meet the high end. They sailed past it by nearly $30 million.
And the profitability just followed suit. The non-GAAP EPS was a huge beat at 767 cents per share.
Which blew past the consensus estimate of around, 49 to 50 cents?
Exactly. That kind of differential and almost 35% beat on adjusted earnings, that's a huge sign of efficiency while they're ramping up.
It absolutely is. Management described Q2 as, and I'm quoting here, the strongest quarterly results in Credo's history.
The market certainly agreed. We saw the stock reverse sharply in after-hours trading. I mean, it rocketed up 15 to 18% almost instantly.
As soon as investors digested it, yeah.
It just set the stage for a new 52-week high the next day. I mean, when a company triples revenue year over year and beats guidance this strong, it really shifts the entire investment narrative.
It shifts from potential growth to realized hypergrowth. And that narrative shift is totally validated when you look past the top line and study the operating dynamics, which, this is the most critical part. It shows exceptional financial leverage.
Okay, tell me more about that operational leverage, because maintaining high margins during a 272% year-over-year revenue explosion is, it's notoriously difficult.
Especially for a hardware-adjacent company, right?
Right.
But they did it. Their non-GAAP gross margin reached a remarkable 67.7%, which was actually above the high end of their own guidance.
Wow. In the semiconductor space, getting margins near 70% shows incredible pricing power.
It does. This is not selling commodity chips. This is selling mission-critical IP wrapped in a connectivity solution.
So how much of that gross margin is actually translating into operating profit?
A huge amount. The flow-through was just stunning. Non-GAAP operating margin landed in the mid-40s, specifically 46.3%.
Okay, how?
Well, here's how. They grew the top line by 20% sequentially, but their operating expenses, their OpEx, it grew only in the mid-single digits.
So that delta between revenue and expense growth.
That's the definition of operating leverage in action.
So the infrastructure's in place, and every new dollar of revenue is just dramatically more profitable than the last. That has to be translating into some serious cash generation.
It is. Non-GAAP net income hit a record $127.8 million. And more importantly, they generated about $54 million in cash from operations.
And their CapEx is pretty modest, right? They use partners.
Exactly. So that leads to excellent free cash flow. They closed the quarter with a commanding balance sheet, something like $813 million in cash and short-term investments. They're financing this hypergrowth from operations, not debt.
So let's pivot back to the engine of this growth. The core driver is still their active electrical cables, the AECs. For anyone catching up, why are AECs the go-to connector for AI clusters right now?
The simple answer is reliability and efficiency, at least in short-reach connections, up to about 7 meters.
Right.
Management was very explicit about their advantage. AECs deliver up to 1,000 times better reliability than standard optical solutions.
1,000 times? That sounds like a marketing claim. Is that real?
It sounds like it, but it's rooted in the reality of running these massive AI clusters. When you have hundreds of thousands of GPUs running jobs for days, a single link failure is catastrophic.
It forces a whole resync of the cluster, right? Wasted time, wasted money.
Millions in wasted compute time and energy. Optical connections with their tiny lasers are just more susceptible to heat, vibration, and dust. AECs using copper are just far more robust, plus they use about half the power.
Okay, that makes a premium price and the high gross margin totally justifiable.
It does.
Now, let's talk about the future, because as staggering as Q2 was, the guidance for Q3 was arguably the biggest news of the whole call.
It was an extraordinary raise. Management guided Q3 revenue to a range of $335 million to $345 million.
The midpoint there, $340 million, that just crushes the prior street consensus, which was sitting down near, what, $247 million?
Crushes it. This means they're forecasting roughly 27% sequential growth on top of the hypergrowth they just reported.
And their long-term conviction seems just as strong.
Yeah, they projected over 170% year-over-year growth for this fiscal year, FY 2026, and said they expect sequential growth to continue in the mid-single digits all the way through fiscal year 2027.
So this is not a one-quarter miracle.
No, they're calling for multi-year persistent growth. And that call is underpinned by a massive expansion of their total addressable market, their TAM.
To over $10 billion, right? Tripling their opportunity from just 18 months ago.
That's the plan.
Okay, but $10 billion is aggressive. Is this a realistic TAM expansion, or is this maybe some creative math looking markets that don't really exist yet?
That's the right question to ask. They are not just extrapolating AEC demand, they're adding 3 entirely new product pillars.
So let's break those down. First up, ZeroFlap optics.
This is their play to move beyond that 7-meter copper limit. ZeroFlap is their first laser-based optical product designed for AEC class reliability, but over longer distances up to 1 kilometer.
What's the key innovation there?
It's the software. It has this real-time link health telemetry, like a check engine light, that lets you decommission a link before it fails completely.
Oh, that's huge for uptime.
It is. They expect initial revenue in FY 2027.
Okay, pillar 2, active LED cables, or ALCs.
Right. ALCs use micro-ND tech. Think ATC reliability and power efficiency, but in a thinner cable that can go up to 30 meters. This is for row-scale networks inside the data center.
And the TAM for that.
The CEO said it could ultimately be more than double the size of the original AEC market. Initial revenue is projected for FY 2028.
And finally, pillar 3, the OmniConnect gearboxes, specifically a product called Weaver. This sounds like it tackles a totally different problem.
It does. Weaver is all about redefining memory-to-compute connectivity for AI inference. It's designed to break through the memory wall.
The memory wall?
Yeah, high-bandwidth memory, HBM, is super expensive and you can't get enough of it. Weaver lets you use cheaper commodity DDR memory, but you get 30 times more memory capacity and 8 times the bandwidth.
That's a game changer for large language models.
Exactly. Initial revenue also expected in FY 2028.
So a very compelling roadmap.
Yeah.
But we have to address the risks. And the first and most critical issue is customer concentration.
The elephant in the room. In Q2, 4 customers were each over 10% of total revenue.
Let's put some hard numbers on that because it's pretty extreme.
It is. The largest customer was 42% of revenue. The second was 24%. The third, 16%. And a newer one was 11%.
42%. If that one customer just pauses a project,
the deceleration would be immediate and brutal, regardless of how strong the rest of the AI market is.
What's management's counterargument?
They acknowledge it, but frame it as, a function of saving the most demanding clients. They expect 3 to 4 customers to stay above that 10% mark, and they say another hyperscaler is about to ramp up. But you're right, any hiccup with the top 2, that's maximum volatility.
Okay, what about the supply chain? The CEO mentioned constraints on advanced node wafers.
Their strategy here is pretty interesting. They call it the N1 process strategy. Yeah, instead of using the most cutting-edge nodes like 3 nanometer or 5 nanometer, which are super constrained and expensive.
They use older tech. Isn't that a risk?
It's a calculated trade-off. They use more mature 12 nanometer nodes. It gives them supply stability and better margins because that capacity is way less constrained. It's a clever way to de-risk the supply chain.
That makes sense. Okay, 2 final cautionary flags. First, the heavy insider selling we've seen over the last 6 months.
Yeah, insider selling is always a yellow flag. No matter the official reason, the optics can be poor when the stock is at all-time highs. It adds a layer of skepticism.
Which connects to the second issue, the prospect of growth slowing down after FY 2026.
Exactly. Investors are buying this stock based on this explosive cycle continuing forever. If growth slows from, say, 27% sequentially down to the 5% they're projecting for FY 2027, the valuation multiples could contract really severely.
The market is basically betting those 3 new pillars kick in right on time.
A perfect transition. It's a huge bet.
But you can't deny their performance. Year to date, CRDO is up roughly 180%, which just dwarfs the SOXX semiconductor ETF, which is up around 40%.
It's a high beta AI winner by every measure. The market is choosing to focus on the guidance and the TAM expansion, and it's giving them the benefit of the doubt on the risks for now.
All right, let's turn to our This Is Not Financial Advice segment. We'll analyze the market structure around this event and pitch an outrageous but plausible trade idea.
Sounds good. So the immediate stock move was huge, that 15 to 18% spike. The options market, though, had priced in an implied move of about plus or minus 19%.
So the size of the move was mostly priced in.
The directional move was, yes, but the fundamentals behind it were way stronger than anyone expected. And that strength is key. The magnitude of that beat suggests the pre-call closing price, around $171, is now a very durable psychological floor.
And historically, after a beat like this, implied volatility for CRDO tends to just collapse, the classic vol crush.
It collapses by 30 to 35%. So you have a belief that the price will hold its new, higher level, and a statistical certainty that the perceived risk premium, the volatility, is about to fall off a cliff.
So the idea is a high conviction short volatility strategy.
Exactly. You want to exploit that collapse in risk premium while betting on the sustained price momentum. We would look to sell an out-of-the-money put spread 1 month out.
Walk me through the mechanics of that.
So by selling a put spread, for example, you sell the $165 strike put and you simultaneously buy the $155 strike put. You collect a big premium from that high pre-earnings volatility.
And you're basically selling the market's fear that the stock will crash back below $165 in the next month.
A fear we believe is unwarranted given the monumental guidance. It's a defined risk way to profit directly from the vol crush and the sustained move up.
A compelling analysis. So, to recap, Credo Technology has cemented its role as a necessary AI infrastructure beneficiary. They delivered hypergrowth with elite margins and have aggressively expanded their future CAM.
The ambition of this quarter and the guidance, it just can't be overstated. But the market is now pricing in this massive growth through FY 2026. So the critical question for you, the learner, to explore is this. The stock is priced for perfection. Given that extreme customer concentration, one client at 42%, and the insider selling, what single sign would cause this highly volatile stock to react most violently? What if just one of those top hyperscalers rephases a single significant order?
Powerful questions. And just a reminder that everything discussed here is purely for informational and educational purposes. It is absolutely not financial advice. Thank you for tuning in to Talk Tickers.